Now, to understand the working of the cryptocurrency, we need to understand these three terms, although we have discussed them earlier also, but a clear definition and detailed explanation is given here. First, public ledgers. All confirmed transactions from the start of a cryptocurrency's creation are stored in a public ledger. The identities of the coin owners are encrypted, and the system uses other cryptographic techniques to ensure the legitimacy of record keeping. The ledger ensures that the corresponding digital wallets can calculate an accurate spendable balance. Also, new transactions can be checked to ensure that each transaction uses only coins currently owned by the spender. That is, there is no double spending. And Bitcoin calls this public ledger as a transaction blockchain. Ledger is also known as transaction blockchain. What is transaction? Transaction means transfer of funds between two digital wallets, and the transaction gets submitted to a public ledger and awaits confirmation. When transaction is made, wallets use an encrypted electronic signature to provide a mathematical proof that the transaction is coming from the owner of the wallet. The confirmation process takes a bit of time, like 10 minutes, while miners are mining it. Mining means they are just confirming the transactions. And mining is the process of confirming the transactions and adding them to a public ledger. Now, to have a clear understanding of the functioning of cryptocurrency, have a look at this picture. First, someone requests a transaction. The requested transaction is broadcasted to peer-to-peer network consisting of computers known as nodes. Computers are known as nodes. Then the validation process starts. The network of nodes validates the transaction and the user's status using the algorithms. Then a verified transaction can involve cryptocurrency, contracts or records. Once verified, the transaction is combined with other transactions to create a new block of data for the ledger. It is entered in the ledger. The previous data as well as the new data, they are combined together, and then the new block is then added to the existing blockchain in a way that is permanent and unalterable. And after that, the transaction is complete. Now, since we are discussing this cryptocurrency topic from the point of the economy of any country, we should understand its basic features as a money or as a currency. First of all, the main feature is the controlled supply. Most cryptocurrencies limit the supply of the tokens or the units. In Bitcoin, the supply decreases in time and will reach its final number somewhere around 2140. At that time, 21 million Bitcoins units will be reached. Therefore, that is the final or the maximum supply of this currency, this cryptocurrency. All cryptocurrencies control the supply of the token by a schedule written in the code. That is written in the code only. Through that it is controlled. This means the monetary supply of a cryptocurrency in every given moment in the future can roughly be calculated today only. Unlike the real currencies or the fiat currencies which are used by the countries, and these fiat currencies, their supply can increase or decrease depending upon the government regulation. Second property is no debt but the bearer. The fiat money on your bank account is created by a debt, and the numbers you see on your ledger represent nothing but the debts, because the government is owing you, government is assuring you that you are holding a 100 rupee note or 500 rupee note. Therefore, it's a system of I owe you. The government owes a person 100 rupees who is holding that 100 rupee note. But cryptocurrencies don't represent any debt. They just represent themselves. they are money as hard as coins of gold. That is the intrinsic value is there. Here one important information here is given that the Citibank estimates that the Bitcoin network will eventually consume roughly the same amount of electricity as Japan. So environmentalists may be against this cryptocurrencies. Now have a look at the transactional properties of the cryptocurrency. First, it is irreversible. After confirmation, a transaction cannot be reversed, and it cannot be reversed by anybody, and neither bank, nor the person, nor the RBI governor, nor Satoshi, nor any miner can reverse it. If you send money, you send it. No one can help you. If you send your funds to a scammer or if a hacker stole them from your computer, there is no safety net as such. Second property is pseudonymous. Neither transactions nor accounts are connected to real world identities. That is, they are not related to the real persons. A person in pseudonym can also function. You receive bitcoins on so-called addresses. Addresses can be anything. It is not necessary that it should be a person, which are randomly seeming chains of around 30 characters. That is, 30 characters is the address to which they are delivered. While it is usually possible to analyze the transaction flow, a trail is there, so transaction flow can be analyzed. It is not necessarily possible to connect the real world identity of users with those addresses. But who was that person who was using that address cannot be determined very easily. Third, fast and global. Transactions are propagated nearly instantly in the network and are confirmed in a couple of minutes. Since they happen in a global network of computers, they are completely indifferent of your physical location. Secure. Cryptocurrency funds are locked in a public key cryptography system, which we have already seen. Only the owner of the private key can send cryptocurrency. Strong cryptography and magic of big numbers makes it impossible to break this scheme. And last property is permissionless. That is, a person doesn't need to ask anybody to use cryptocurrency. It is just a software that everybody can download for free. After you have installed it, you can receive and send bitcoins or other cryptocurrencies. No one can prevent you. That is, there is no gatekeeper as such. Now, we have to understand the effect of cryptocurrencies on an economy. First of all, if there is to be no intermediary and no regulation, which is the main theme of cryptocurrencies, what will be the role of the central bank? And because of this suspicion, the concept is seen with some hostility by the banks, although they have not rejected it outrightly at this point of time. And generally, it has been propounded that the increasing use of cryptocurrencies will have these three important effects on an economy. First, it influence the price of credit for the whole economy. It will influence the price of credit for the whole economy because the price of credit is determined keeping in mind the supply of the money. But at this point of time, it is difficult to know how much is the virtual money and how much is the real or the fiat money. So if this two kind of systems are operating at the same point of time, it will be very difficult for the RBI or any central bank to decide about the price of the credit because they don't know exactly what is the money supply. Secondly, it will make it difficult for statistical agencies to gather data on economic activity because there are two kinds of transactions taking place. One is in the virtual world, another is in the real world, and since they are cryptographically kept secret, although it is possible to get the trails, but since government is not involved in the process, it is very difficult to understand what kind of economic activities are taking place through these transactions. Therefore, the GDP of the country cannot be known exactly. Third, there will be intergovernmental challenges to determine exchange rate policies and so on. Like how much should be the exchange rate between a dollar or the rupee. It will also be affected because again that supply of money is not available. The data regarding supply of money is not available. At the bottom we are giving some interesting facts so that you keep on concentrating on this long lecture. Like in Punjab, one person was kidnapped and the gang asked for a ransom in bitcoins, that is they asked for the 20 bitcoins. So you can see how much popular these cryptocurrencies are becoming. Now we will list out the major differences between the traditional banking system and the cryptocurrency system. First, regarding the recognition, traditional banking system has already been established system and it is well recognized, whereas cryptocurrencies are under the process of development and they are not recognized by most government. On the criteria of supply cap, we can say that the traditional banking system work on regular fiat money. Like rupee is the reserve currency and can be printed at will as and when needed. Like printing of money when deficit financing is done. The supply is not capped. Here the maximum supply is not capped. It can be lowered as well as it can be enhanced. But in cryptocurrencies, the supply is capped. Like bitcoins, the cap is 21 million units. Moreover, on the criteria of manipulation, we can say that the banking system is open to manipulation of figures, exchange rates and tampering by high profile bankers, which is happening and which happens on regular basis. And due to the ease at which traditional money is printed slowly, loses its value. We see that the value of money which was in 1980s or 1990s, that value has diminished. But in cryptocurrencies, the manipulation of figures is not possible because there is a complete trail which is authenticated one. Then there is the issue of reversing the payment. The banks have certain obligations and in case of any mistake, they can reverse the payment. But in cryptocurrencies, once a payment has been made, it cannot be reversed. The next distinguishing feature is the network requirement. For traditional banking system, which uses cash, and for cash, it does not require a network connection or electricity. But in cryptocurrencies, network requirement is one of the most important requirement. Moreover, the bank cards issued in the traditional banking systems are accepted everywhere, but cryptocurrencies cards at this point of time are not accepted everywhere. On the criteria of trust, we can say that the traditional banking system is based on the trust over institutions or the government. We are taking the rupee note, 100 rupee note, because we have the trust on the government and the RBI, because they have said that I owe 100 rupees to the bearer of this note. But in cryptocurrencies, which is basically founded on the theme of trustless system, it does not require trust of any one entity or corporation to the work. It believes in the intrinsic value. Cost of operation, the transfer charges are applicable in traditional banking system, therefore they are more costly. And cryptocurrencies, they are cheap to send transactions with no extra charges between the countries. Here we have listed the benefits of the cryptocurrencies, and as a payment system, cryptocurrency has certain benefits. over the existing electronic systems, and these benefits largely accrue to the recipient of a Bitcoin transaction, but certain benefits may be realized by senders of transactions, that is customers or spenders also. First benefit is decentralization. So it is extremely resistant to censorship, no control. Second point is transparency. All Bitcoin networks transactions are cleared in the blockchain, authenticated there, meaning a complete, auditable and immutable record of all activity exists. No forgery is possible, which is the next point. Once sent and cleared, a Bitcoin transaction cannot be reversed by the sender. Fourth point is low or no transaction cost. Fifth is nearly instantaneous transactions. Bitcoin network transactions registered almost instantaneously. Confirmation and clearing of those transactions can occur within minutes to over an hour. Then there is the network security. The Bitcoin network itself is highly secure due to use of cryptographic and decentralized blockchain protocols. Then protection of financial information. Bitcoin transactions can be performed without having to reveal sensitive personal and financial information to the recipient. Like we already have seen, the transactions happen on the basis of address, which is just a number. Then the last point is financial access. Although it can provide all of the services of banking institutions, and its technical complexity may be too high for many users. It is quite complex system for a common man. Few other drawbacks of the system are listed here. Not possible to stop. Although it is possible to observe a Bitcoin payment in process, it is not practicably possible to stop it once it has been completed. Difficult to use. Bitcoin is not consumer friendly. Most software to control, custody or transact in Bitcoins is complex or difficult to use. Difficult to access. Although the Bitcoin network is open access and liquid market exists in certain economies, few of the exchanges and services that allow the purchase of Bitcoins are regulated and have a significant operational history. Difficult to secure. Although the blockchain and the cryptographic protocols that underlie Bitcoin are secure, users must safely store and use their private keys in order to safeguard their Bitcoins. It lacks protection against mistake. Unlike traditional electronic payments, Bitcoin transaction cannot be reversed and no administrator can restore access. Limited retail and institutional adoption right now. So the next question is, can you use Bitcoin as currency? The answer to it is, at the moment the Reserve Bank of India has banned transactions in India using cryptocurrencies. So the situation is that while you can buy and sell cryptocurrencies on online exchanges, you can't use them to pay for goods and services within the country. And in April 2017, the government had constituted an interdisciplinary panel to look into the legality of the cryptocurrencies and suggest a way forward for regulating it. The panel has submitted its report in August 2017, which has not been made yet public, and it is expected that the government is going to shortly take a decision in this regard. Moreover, the Reserve Bank of India has openly expressed that it is uncomfortable with non-fiat cryptocurrency like Bitcoin. Moreover, it is also mulling the idea of the fiat cryptocurrency, that is cryptocurrency or the digital currency which will be issued by the RBI or the government in place of the physical one at the present. Another interesting information is that Microsoft accepts Bitcoin for payment on its online store, and PayPal also offers integration for merchants to offer the cryptocurrency as a payment option. Now, coming to the topic of regulation of the Bitcoins or the cryptocurrencies, which is under discussion in the Ministry of Finance as well as within the offices of the RBI in India. So, first of all, we should understand the status of Bitcoin at present in context to the Indian legal circles, or what is the status of Bitcoin as per the prevalent rules, laws and regulations in India. The entry number 36 and 46 of List 1 of the 7th Schedule of the Constitution states that the central government is allowed to legislate in respect of currency, coinage, legal tender, foreign exchange and bill of exchange, etc. But the question arises is whether virtual currencies such as Bitcoin can be said to come under the definition of currency, whether they are currency. The answer to this question can be found in the maxim. This maxim says that the express facit cessare taxitum, meaning when there is express mention of certain things, then anything not mentioned is excluded. So basically we can say that virtual currency, since it has not been mentioned in the list as given in the 7th schedule, as well as other currency related laws like the FEMA, it can be said that they cannot be considered as currency, while it may be argued that it may fall under such other like instruments or such other instruments, but for that it has to be specifically notified by the RBI, which has not been done so far. What I am trying to say here is that as per the list given by the FEMA as well as the 7th schedule of the Constitution, the word virtual currency has not been used. But what they have used? They have used the term other like instruments. So for specifying that other like instruments, RBI or the government has to amend those rules and specify that other like instrument means the virtual currency. But right now there is no such declaration in respect of the cryptocurrencies in general or Bitcoin in particular, and RBI has merely advised the public to be cautious regarding the trading of virtual currencies. In order to decide regarding the regulation of Bitcoin, the government should also be clear whether Bitcoin is a good or a commodity. Then only decision regarding the taxation can also be done. Here we can say that the Sale of Goods Act, which defines the good, says that every kind of movable property other than actionable claims and money, and includes stocks and shares, growing crops, grass and things attached to, they are to be termed as goods. So going by this definition, we can say that Bitcoin falls under the meaning of goods. Moreover, in its judgment in the case of Tata Consultancy Services versus State of Andhra Pradesh, Supreme Court has stated this, that the computer software is intellectual property, whether it is conveyed in disks, floppy, magnetic tape, CD-ROMs and like that. And going by that, we can say that Bitcoin may be liable for taxation also. So the present picture is that on the interpretation of the law, it is very much clear that the Bitcoin may be classified as a good and sales tax may be imposed on it. Right now GST can be imposed on it. Now we look at the legal and the regulatory status of Bitcoin around the world, and most importantly the major countries. In Australia, it is classified as a property and capital gain is applied on it. Whether it comes under Anti-Money Laundering Act, it is not applicable. In USA, it is classified as a property, and regarding taxation in New York, capital gain is imposed on it, but sales tax is not applicable. Regarding Anti-Money Laundering Act, we can say that requirements as applicable on money, services and business are imposed. In Japan, it is a legal method of payment. It has been recognized as a legal method of payment, unlike India, and it is exempt from consumption tax but subject to the capital gains tax. And regarding the anti-money laundering thing, the virtual currency exchanges must conduct KYC requirements and report suspicious transactions to the regulators. In UK, it is recognized as asset or private money and it is exempt from VAT, but capital gain tax is applied. Similarly, in China, it is classified as a virtual commodity. Taxation is not applicable. Anti-money laundering or terrorist funding regulations are not applicable. So, regarding the banning of Bitcoin or not, the current status is this, that the government is considering the introduction of a regulatory regime for virtual or cryptocurrencies, and that would enable it to levy GST on their sale. Moreover, the government may possibly bring their trading under the oversight and stock market regulator, SEBI, and the idea is to treat such currency in the similar manner as gold sold digitally. Moreover, it has been reported that the government is considering the possibility of introducing its own cryptocurrency, which will be called Lakshmi. If introduced, Lakshmi would run on some variation of the blockchain technology employed by the Bitcoin that verifies every trade and rules out dual transactions employing the same coin. However, the Reserve Bank of India would have to solve several tricky questions before introducing Lakshmi.